In March 2026, the market's favorite dividend ETF, SCHD, underwent its annual rebalance and executed a trade that appeared entirely backwards. The left side of this chart shows top-performing energy stocks like Valero, up 80% on the year, getting aggressively dumped. That capital flows into healthcare and tech stocks like UnitedHealth, which was sitting on a 48% decline. If you held SCHD to ride the energy boom, this looked like a system failure. Retail forums surged with questions about whether the algorithm had broken or if this was a calculated risk management move. While retail investors reacted with confusion, institutional index managers executed these trades with the calm of a pre-programmed script. Mastering rules-based dividend investing requires looking past emotional market hype to understand why an $85 billion fund would intentionally sell its winners to buy beaten-down laggards. Institutional smart money is currently executing a shadow rotation, pulling billions of dollars out of high-priced, speculative software stocks. This is the physical AI layer. The industrial power grid nodes, water cooling pipes, and electrical towers required to operate high-density data centers. Building this infrastructure is capital-intensive, and it is the primary engine driving global capital flows across the market today. However, SCHD just slashed its energy exposure by 8 percentage points, moving in the opposite direction of this infrastructure pivot. Chasing dividend yields without knowing how an ETF reacts to these institutional rotations can leave a portfolio stranded on the wrong side of the market. SCHD functions through a strict, emotionless, rules-based index rather than a human portfolio manager. Before the algorithm evaluates a company's balance sheet, that stock must demonstrate 10 consecutive years of dividend payments. As a stock's price shoots upward, its dividend yield drops below a minimum threshold, triggering an automatic sale. Conversely, a falling price pushes yield up. Passing cash flow and debt screens triggers a buy. The result, outgoing stocks averaged 37% dividend growth, while incoming boasts 63%. This mechanical pruning forces investors to hold unpopular stocks, but it is precisely how the fund locks in gains and rotates out of cyclical peaks. Vanguard's High Dividend Yield ETF, VYM, represents the philosophical opposite of those strict quality screens. Where SCHD concentrates on roughly 100 stocks, VYM casts an expansive, market cap-weighted net over more than 500 dividend payers. By holding nearly every large dividend payer, VYM acts as a macroeconomic sponge, absorbing broad market trends instead of filtering strictly for dividend history. This sector breakdown shows how VYM captures the physical AI trend. Alongside its weight in financials and industrials, the fund maintains a 6% position in the utility sector, exposing investors to the companies powering hyperscale data centers. Because SCHD explicitly excludes real estate and holds no utilities, it has a structural algorithmic blind spot for this infrastructure boom. VYM ensures you won't miss broad market rotations, but you must accept a portfolio containing lower quality pairs that a stricter algorithm would reject. That expansive net impacts the immediate payout. Holding hundreds of lower-yielding companies dilutes VYM's starting yield to approximately 2.3. The fund is heavily weighted in just 3 sectors: energy, consumer staples, and healthcare. Extra income is never free. With SCHD, you are purchasing that yield by accepting sector concentration and trusting the algorithm to manage the downside. Matching these methodologies to a specific retirement timeline is the final step in the process. For income-reliant retirees who prioritize balance sheet health and require a higher immediate paycheck, SCHD is the mathematical preference. This choice requires psychological patience. You must be comfortable watching the fund sell high-flying momentum stocks to buy turnaround plays. Strategists prioritizing exposure to institutional rotations into industrials and utilities without single-stock risk will find VYM to be the necessary vehicle. We can map this on a quadrant chart. The horizontal axis is broad macro exposure. The vertical axis is current high yield. SCHD occupies the top left for high yield but lower macro coverage. VYM plots bottom right, broad exposure at the cost of immediate income. The best ETF depends on whether a portfolio needs a strict quality control gatekeeper or a sweeping macro net. Every dividend ETF represents a specific mechanical methodology. Selecting one means prioritizing those underlying rules over the headline yield. Passive, rules-based algorithms will eventually force uncomfortable trades, such as selling top-performing winners. That discipline is the primary feature of the fund. The trade-off exists between the smoother, diversified volatility of VYM and the concentrated income growth engine of SCHD. Identify which mechanical blind spots you are most comfortable living with during the 2026 market shift, rather than fighting the index rules. Long-term dividend success is built by picking a system, trusting the math, and letting it run uninterrupted.